You open the news, record profits, markets at all-time highs. The economy avoids recession. Then you open your banking app. Rent is higher, groceries are higher, your savings are unchanged. Two realities, both of them real. The S&P 500 ended 2025 with another strong year. Corporate profits stayed elevated, the official language stayed calm, and yet, for millions of people, daily life did not begin to feel lighter. It felt tighter. The bills still arrived, the margin still felt thin, the future still felt delayed. So, which picture are you supposed to believe? The charts or your own life? Today's answer is uncomfortable. Both are true, and that is exactly the problem. Growth is real, access is not. There is a story most people absorb without noticing. If the economy grows, life improves over time. It sounds fair. It sounds almost automatic. But the story hides one assumption: that growth spreads. That if the total number gets bigger, the benefits gradually move outward. They don't, not on their own. Growth concentrates in financial assets, in balance sheets, in structures that require capital, legal access, and staying power to enter. That is the mistake at the center of modern economic thinking. People hear the word growth and imagine distribution. But those are not the same process. A system can expand without broadening participation. A market can rise without changing who captures the rise. An economy can look healthy from above while feeling harsher from below. This structural disconnect is not merely about fluctuating numbers. It is about a fundamental shift in how the engine of the modern world operates. In the old economic model, growth functioned like a ladder. When the bottom rung rose, the others followed in sequence. Today, that ladder has been replaced by an elevator system. The problem is that the elevator only opens for those who already meet a specific asset threshold. For everyone else, they are left to climb a manual staircase that grows steeper with every floor the elevator bypasses. Here is the mechanism. The system grows through assets. Most people live through wages. That difference sounds small. It is not small. It is the dividing line. When growth appears, it shows up first in stocks, bonds, real estate, private equity, and business ownership. That is where expansion is recorded. That is where wealth compounds. But most people do not live inside those channels. They live inside salaries, rent, food, transport, insurance, debt payments. The cost of holding a normal life together. So there is a structural split. Growth happens in one layer, life happens in another. And when those layers drift apart, the headlines and the households stop speaking the same language. Asset holders experience expansion as appreciation. Wage earners often experience the same expansion as prices moving faster than relief. That is not rhetoric, that is architecture. This is where the asymmetry between asset inflation and the cost of living becomes a predatory force. When a stock index hits a record high, it represents the present value of a corporation's future cash flows. But when the price of basic necessities spikes, it represents nothing more than the erosion of your current survival margin. One is a tool for building a future, the other is a tax on existing. The system utilizes capital to buy the future while forcing labor to finance the present. The headlines celebrate the increase in total wealth, but they ignore that this wealth is locked in a vault that requires an entrance fee most cannot afford. A lot of people still believe the old promise: if firms earn more, workers will eventually earn more too. Sometimes that happens. Often it does not happen fast enough to matter in the life of the person waiting for it, because wages are not just connected to growth. They are connected to bargaining power, labor market structure, and how much of the upside is reserved for capital. Growth can be real without becoming broadly livable. The gains can remain concentrated long enough that the average person experiences the economy mainly through cost. They are not missing the growth, They are standing outside the channels where growth lands first. There is a line most people never notice until it is already behind them. The line between consuming and owning. Before that line, growth often shows up as a more expensive version of ordinary life. Housing rises, education rises, the cost of entry rises. After that line, those same moves look very different. Housing becomes equity, markets become compounding, business ownership becomes leverage over future income. Same economy, same growth cycle, different position. This is why ownership matters so much. If you don't own productive assets, you don't capture much of the upside created by asset inflation. You confront the side effects instead. You pay the rent. Someone else holds the appreciation. You face the price increase. Someone else holds the margin. Ownership is one gate. Leverage is another. Growth alone builds wealth slowly. Leverage can accelerate it. But debt is not one thing. It behaves differently depending on why it is used. Debt used to acquire assets can expand optionality. Debt used just to survive removes it. One household uses credit to buy a property or finance a business because it has collateral to hold against. Another uses credit to cover a shortfall, a medical cost, or a broken car. Same word. Completely different function. For one side, debt amplifies upside. For the other, it amplifies fragility. Access to credit is not one thing. Cheap credit paired with assets becomes acceleration. Expensive credit paired with insecurity becomes compression. One side buys time, the other side rents it, and rented time gets expensive. This one matters more than most people realize. Access is not only about money, it is about time. Who can wait? Who is forced to sell? Who can hold through volatility? Who must accept the worst terms because the bill is due right now? The system rewards patience. But patience is easier to afford when you already have reserves. A family with savings, stable housing, and low debt can wait through bad markets or short-term uncertainty. A family without margin cannot wait. It reacts earlier, sells sooner, refinances under pressure, cuts investment in its own future. The concept of time arbitrage functions here with ruthless efficiency. In the financial layer, time is a multiplier of wealth. In the lived layer, time is merely a commodity sold for survival. If you lack reserves, you are forced to sell your time at whatever price the market offers today. If you have assets, you use your wealth to buy back your time, allowing you to wait for the most profitable moment to act. This gap determines not just who survives a crisis, but who emerges from it with more power than before. Access is not evenly distributed because the system is not entered from one doorway. It depends on capital, credit history, legal structure, tax treatment, and institutional stability. Some participants move across markets with very little friction. Others meet friction everywhere: paperwork, fees, restrictions, higher borrowing costs. Furthermore, we are seeing the rise of algorithmic exclusion. Modern credit and banking systems no longer just look at your income, they analyze your systemic fit. If you stand outside the ownership line, you pay a trust premium on every transaction, from insurance to interest rates. This makes life mathematically more expensive for the person at the bottom than it is for the person at the top. It is a technical trap where being undercapitalized is treated as a high-risk behavior that must be penalized. At some point, this becomes a story about self-reinforcing power, because access doesn't only determine who benefits, it helps determine who shapes the rules. Those who hold assets and control capital gain more than returns. They gain influence. Over time, policy drifts toward preserving stability in the zones that matter most to asset values. Not always because of intent. Usually the process is less theatrical. The system protects what it is built to measure, what it is built to fear, and what it is built to stabilize. And what it measures most carefully is not always what households experience most painfully. Access generates gains. Gains generate insulation. Insulation generates influence. Influence helps preserve access. Ultimately, what policymakers call stability is usually just the preservation of asset values. The volatility of your household budget is treated as mere statistical noise. Therefore, that feeling of alienation when you hear the economy is booming is not a delusion. It is a correct reading of a machine that is no longer calibrated to your frequency. Collapse does not always begin with falling numbers. Sometimes it begins with breaking alignment. When enough people feel that the system grows without becoming more livable, trust starts to erode. The data may still be correct, markets may still be functioning, but the social reading changes. People start to feel that the rewards are upstream while the pressures are downstream. That risk is personal, but resilience is institutional. At that point, what people lose first is not money, it is belief. Belief that effort connects to advancement. That is why this begins to feel like exclusion. An exclusion, if it lasts long enough, changes everything. The political climate, the social climate, the emotional climate. There is one more layer most people never see. When pressure builds, the system does not always break immediately. It adjusts. Credit tightens quietly. Opportunities narrow without announcement. Risk is pushed away from balance sheets and into places that are harder to observe. Nothing looks dramatic. No headline says access has been reduced, but fewer people qualify. Fewer deals close. Fewer chances reach the surface. From the outside, everything still appears stable. From the inside, the system has already begun to select who is allowed to participate. That is how exclusion scales, not through visible collapse, but through invisible filtering. So how should this be read? Not as the numbers are fake. The numbers are real, but they describe total expansion, not shared access. Growth is real. Access is filtered. Participation is conditional. Upside is positional. Once you see that, modern confusion organizes itself. Why can strong GDP coexist with stress? Why can booming markets coexist with delayed adulthood? Because growth is being captured in one layer while strain is being absorbed in another. That is the mechanism. Growth continues. Access narrows. The numbers hold. The experience does not. And at some point, that gap stops looking like inequality and starts behaving like failure. Not a dramatic crash. A slow structural separation between what the system produces and who the system is actually built to reward. Growth is real. Access is not. And until that sentence becomes part of how people read the economy, every record high will continue to feel, for millions of people, like someone else's story.